During our last economic update, we were looking at a stock market that was celebrating the fact that the Federal Reserve appeared to be forecasting weaker than expected economic growth. What we saw happening then was, through the comments that the Federal Reserve was making and some of the economic data that came out, the market adjusted their expectations at the beginning of the year, which was 4 interest rate hikes, down to 1 or possibly no interest rate hikes. Over that time period, over the last 5 months since our last update, we've seen some data that's come out better than expected and some that has definitely confirmed the Federal Reserve's belief. So what's really happening with the stock market, and what do we see the Federal Reserve having to wrestle with as we go into the last quarter of the year? We're going to talk about that in today's SEM Economic Update. First off, let's look at what's going on with the economy. This chart of GDP growth really tells the story. Despite some unprecedented stimulus measures, growth really has been, I would call it pathetic. Lackluster might be a better term. Or if you just want to look at the data and remove all my opinions, it's below average. There's no arguing that. It's below the long-term average, and it's really struggled to get back to that. In fact, if you look at what the Federal Reserve considers average, you look at what this Congressional Budget Office considers average, and almost every other economist out there, they point somewhere around 3%. In fact, if you look at the long-term average growth rate of our economy going all the way back to 1947, which they call the post-World War II era, we're talking about 3.2% is the average economic growth, and so everybody believes we should get back to average. So we saw all the stimulus being poured into the market, whether it was the Federal Reserve and their quantitative easing. They slashed interest rates at the beginning of the recession. They kept them basically at zero all this time. We saw TARP, we saw the American Recovery Act, we saw all kinds of deficit spending going on by the government trying to boost things. Despite that, we've only had 2 of the 28 quarters, that's 7 years, 2 of the quarters where growth has been above 3% for that 1 year. Something is going on here, and nobody seems to want to address it. However, if you back up and say, well, let's just focus on the short term, what's the market focused on? We've seen progressively lower growth rates on the economy. Now, first off, let's take a step back and realize the way the official GDP number works is a little bit different than how we would see things happening in the real world. What the government essentially does, and this is the way most economists do it for some reason, is they take the last 3 months of data, what the growth rate was versus the prior 3 months. They throw in some seasonal adjustment factors. For instance, obviously growth is usually strong for Christmas, and then we see a January effect where growth is not slow. So they work their magic to adjust them seasonally, and then they essentially multiply that number times 4 to give you a 1-year growth rate. Well, I've argued for quite some time, I've heard other big firms argue it as well, that when you consider some of the bad effects that happened in 2008, remember, that was the fall, that was supposed to be a very strong time for our economy, we have some screwy things going on there. So in order to try to remove those seasonal adjustment factors, I use the 1-year growth rate. Even with that, keeping that in mind, we've seen that slower growth, and in fact we've seen the 1-year numbers only 1.2% over the last 12 months in this most recent quarter, and that's definitely disappointing. My GDP estimates show that our economy is growing somewhere between 2.3 to 2.7. It's actually increased from our last update in March. What I see happening is a combination of these seasonal adjustment factors, but you have an unknown inventory adjustment factor. We've seen really just a sharp reduction in inventory buildup, and you can look at it one of 2 ways. It could be we see the big businesses backing down their inventories and saying, we see a slowdown coming, so we're not going to do things, or they're just so concerned of having too many inventories they don't want to be caught on the other side, which then could lead to a massive buildup of inventories if economic growth is doing well. Looking at the consumer, which is 70% of our economy, the data is still pointing to that 2.5% to 3% growth rate. So what I'm guessing will happen is we're going to see a surge in inventories where businesses scramble to catch up to what's really happening with the economy, which will then boost the GDP numbers. And in fact, if we look at what the Federal Reserve is doing, we have the Atlanta Fed and we have the New York Fed. The Atlanta Fed's on top, and they're essentially doing what I do with my economic indicators, except they're converting it to the official GDP number. So they're pouring all the data into their models and saying, based on this activity, based on history, this is what we see the economy doing. And so what we see is a little bit conflicting data from the Atlanta Fed and the New York Fed. Somewhere, though, the third quarter expectations are for 2.5% to 3.5% GDP growth. So if that is the case, and the Fed's been telling us that the economy's been slower than they expected and now it starts picking up steam, the $1 trillion question, or I guess if you add up all the money that the Fed has on their balance sheet, the $4 trillion question is, will this pickup in growth be enough for the Federal Reserve to decide to raise interest rates? And we saw from the minutes just this week of their July meeting, there's an increasing volume of people on the Federal Reserve Board that are saying, look, we need to start raising interest rates before things start getting too heated up, which then could cause all that money the Federal Reserve created in quantitative easing to get out of the reserve accounts at the Wall Street banks and actually be put into circulation, and then all of a sudden you have this runaway inflation, and that starts to become an issue. So that's really what the market is going to be wrestling with if we hit those GDP numbers that the Federal Reserve is forecasting. Now the real issue, the focus is going to be on inventories, and what we saw happening in the very end of the second quarter now may be reverting back to, we're still not seeing that inventory rebound. The best leading indicator of what's going to happen with the business side of things is the manufacturing activity, and we look at things like the order backlog, the new orders component, the deliveries component of what's going on inside the manufacturers, because obviously if consumers are spending money, we want to see those manufacturers building things, selling them, and then we want to see the inventories building, which then causes that boost in economic activity. And right now, we saw two of those components just in July, deliveries and the order backlog, drop significantly. So we're going to keep a close eye on these manufacturing numbers. I really like them anyways because you get them the first business day of the new month. So here we are, August 18th. So by September 1st, which happens to be a weekday, we're going to know what the manufacturing activity was for August. And so that's going to be really a key thing. That data will come out before the Federal Reserve meets, so it's a really good leading indicator of what's happening with that inventory buildup. And if things start to overheat, we could see the Federal Reserve forced to act and raise interest rates. The real driver, I think, and the real thing that I think is important to watch is housing. And this kind of goes in the camp of maybe the Federal Reserve is correct to not raise interest rates, because we've seen housing slow down dramatically this year, and it's something that I think we should all be paying attention to. If we see the Federal Reserve decide to raise interest rates, we could see a very, very rapid decline in housing, and that can then filter through to the rest of the economy. However, if we see housing stabilized, then it may be something where the Federal Reserve says, oh, we need to raise rates to slow things down, because we've seen a lot of speculation again happening in the housing market. And what happens there, again, that $4 trillion question of what should the Federal Reserve do with rates? It's something that we really need to be watching, because one thing we've learned throughout studying the Federal Reserve is they tend to overshoot. When we're in an economic recovery, they tend to keep rates too low, stimulus on the table for too long, and then things start to heat up too fast, and they start to see asset bubbles and inflation, and they panic, and then they raise rates, but they raise them for too long, and then all of a sudden you're dealing with, they cause a recession, and then they react to the other side. Now, we have seen a very cautious Janet Yellen as far as raising interest rates goes, but we're now starting to see people at the Fed saying, look, we said we'd be data dependent. We're basically at full employment. Wage inflation is basically at our target and is threatening to get too far ahead. We've got to do something to slow this down. So we're seeing that pressure at the Fed that they may raise rates. And then because we're dealing with a $19 trillion economy here, it takes a while for things to kick in. We saw that with quantitative easing, where when it ended, it's taken a while for things to filter through to the economy. I don't think it's much of a coincidence that we've seen the economy, just with the Federal Reserve just stopping their bond purchases, we've seen economic growth continue to decline. I also think, on the other hand, we see this paralyzation from the schizophrenic activity going on at the Federal Reserve. And what I'm talking about is you see them, oh look, the economy is doing really well, we're afraid it's going to heat up, we may have to raise interest rates. And then the stock market panics. And then the Fed says, oh, never mind, looking at the volatility of the financial markets, we're going to hold off and we'll be slow about this. And then the market rallies. And what's happening from a business perspective and from an investing perspective is everybody's so focused on that short term, is, they're looking down as they're walking, and they're not looking ahead to what's actually happening out there. Why are the markets so sensitive to what the Federal Reserve is doing with rates? Who really cares? If you're a plant owner and you need to buy new equipment, whether you pay 5% or 5.25% interest over the long run, if this is really a net positive cash flow for your company, doesn't really matter. But still, we see this focus on short-term events, both by the Federal Reserve, business owners, and investors. It's really causing everything to just be paralyzed as far as making those long-term decisions. Housing obviously is a long-term decision, and that's why we like to watch this indicator. Right now, it's saying, maybe the Federal Reserve should wait a little bit longer. But the question really then becomes, how long should they wait, and is what they're doing actually helping over the long run? This is something that I think we're seeing really heat up during the election season, is we're hearing people saying, oh, we need to spend more money, or we need to cut taxes on businesses and the wealthy, and then it will all trickle down to everybody else, which is essentially raising government spending. That's spending more because you're going to have a bigger deficit. And the assumption on that side of the aisle says, well, that'll cause businesses to spend money. But look, we've seen businesses have their tax rates cut over and over and over again throughout this recovery. We've seen massive government spending on the other side of the things, and it just hasn't paid off. I mean, it's amazing to think about how much money has been poured into the economy at what price. I mean, you look at the numbers on the chart. For every dollar of economic growth, it's taken $4.78 of government spending and Federal Reserve stimulus. It's taken $6.42 of spending to generate one additional dollar of personal income. And then this is the number that just blows me away. The president's running around patting himself on the back, talking about this great jobs recovery. It's cost us $741,000 for every job created. Is that really worth it? If somebody worked 25 years, it's going to take us at least 15 to 16 years at the average wage of those jobs to get that money back into our system. Yes, I understand if you're unemployed, that job is really important, but from a whole, from that long-term perspective, $741,000 is money we have to pay back down the road. So when you wonder why are we having such slow economic growth, it's because we're so focused on that short term. Instead of saying, look, maybe we have issues with our economy. Maybe there's good government spending and there's bad government spending. How about we figure out what the good government spending is? You look at TARP, Troubled Asset Relief Program. The plan was originally to go through the books and decide, okay, these are the assets we'll buy. Instead, they just decided, oh, we'll give the Wall Street banks some money and then they'll figure out what to do. You looked at the other bailouts that went on. You look at the American Recovery Act, and it was simply, oh my gosh, the short term looks so bad, we're just going to throw a whole bunch of money at this thing and hope that it all works out. Well, here we are 7 years down the road, and it's obviously not working. 2 out of 28 quarters have been average growth. During a recovery, we should see above average growth, because that's how you get to the average, is you have a recession that pulls the average down, and the recovery that is above average, and it all ends up back at average. We haven't gotten that. Something is broken, and nobody seems to understand that. That's what's happening in the election. That's how you get the Donald Trumps and the Bernie Sanders supporters to just say, you know what, we need to do something differently. The problem is we have people at the Fed and still the people in Congress and the people running the Republican and the Democratic parties using the same old tired things that just simply aren't working. Look, we've gone through a big demographic shift in our economy. We had the growth of the baby boomers, working, both husband and wife going into the workforce, creating a tremendous boom in the economy. They were income producers. Well, now as they retire, they become income spenders. They're sucking off that teat of the government, pulling all that money out of it, and yet we don't have the money generated from a new generation of producers. We need to figure out how to produce that money so that we can support those people spending the money now. And the answers we're seeing just aren't there. So again, that's the long term. When you're looking out over the long-term time horizon, that's what we're dealing with. And instead, everybody's just walking around looking down. As investors, we have to do a little bit of both. My advice is don't get sucked into this belief that, just because the market's higher, everything's going to be great. It's been fine. Everything's worked out great now. But I'm looking at what I'm seeing investors doing now, and it looks so much like what they were doing in 2007. It looks so much like what they were doing in 1999. Remember, I've been here since 1998. I've seen it happen. And it's not different this time. Sooner or later, that day of reckoning comes, and all of a sudden, we've been walking along, focused on the short term, hopping over all those little bumps, and then all of a sudden, those long-term things that were way off in the horizon that we said, we'll deal with it when we get there, guess what? We get there, and then you're staring at this pit. You need to be careful to not fall in. You need to look at the long term. You need to make sure you're in that right portfolio. Can you handle the risk? Because markets do go down. And they're going to go down when we get to that long-term issue. I don't know when it will be. I've been saying the economic growth is fine in the U.S. The worst bear markets occur during a recession. Our economic indicators don't say we're going into recession. However, if the Fed screws things up, if they raise rates too fast, if they let things go on too fast and then they're forced to raise rates, it's probably going to be the Fed that causes a recession. I'll throw in a different asterisk on this and say it could be Congress and the next president causing it. It just depends on what the policies are and what's happening. Our economic environment is so unstable. We focus so much on avoiding the short-term potholes that we now have this giant sinkhole in front of us, and it's getting closer and closer and closer. And the next president and the next Congress may be the ones to just step on the accelerator and drive us over that cliff, or they may be able to find a slightly different route to delay things before we go off into the sinkhole, but we're going to have to deal with it sooner or later. As an investor, it's critical that you understand what's going on with your portfolio and everything else. So I end, it feels like the last year I've been saying now more than ever, it's time you stay on top of things and you figure out what really matters. My daughter Courtney recently helped me this summer redesign our website to make it even more relevant, to make it easier to find things, and mainly to take all the noise off. I mean, you see I have Bloomberg going on behind me. It's on mute most of the time. I like to have it when key market data comes out so I can see the reaction. I like to hear what traders have to say. But that's my job. I then take all that information, all that noise I've heard, and I filter it out into my daily blog where I focus on what really matters. That's the short-term focus. This is what the market's looking at over the short term. That's for people who maybe have money to invest. Maybe they're looking at having to withdraw some money for a big purchase. This is what you should be doing with your portfolio over the short term. And then I also do something, I just call it weekend reading, where that's more the bigger picture. Those are the things we're looking at. Recently, we've posted things you can see on there, "In Fed We Trust." I look at some of the things the Federal Reserve was saying leading up to the recession, and in fact, after we were already in a recession last time. So if you have trust in the Fed, maybe you should read that article and decide, you know what, maybe they don't know what's going on. I looked at things like the broken model. Why is our economy not doing well? I break it down into simple, easy to understand terms. So whether you're looking at the short term or the long term, we have the resources there for you. But most importantly, just stay nimble, stay at a place where you're not sucked in. Don't keep focusing on the short term. Look at your long-term financial picture. And until next quarter, just keep focusing on what really matters.